Profitability analysis is the most crucial part of stock analysis process. It tells you how much profit is the company generating relative to the amount of money invested in the business. This analysis is the real key to separating great companies from average ones. Because the job of any company is to take money from outside investors and invest it to generate a return. The higher that return, the more attractive the business. As an investor, we need to know how much economic profit a firm is able to generate per rupee of capital employed, because it will have more excess profits to reinvest, which will give it an advantage over less efficient competitors. Think about it this way. A company's management is similar to manager of a mutual fund. A mutual fund manager takes investor money and earns a return on it by investing in stocks or bonds. Wouldn't you rather put your money with an equity manager who has consistently generated returns of 15% per year than who has returned an average of only 9% per year? Companies aren't much different. They take shareholders' money and invest in their own business to create wealth. By measuring the return that a company's management has achieved through this investment process, we know how good they are at efficiently transforming capital into profits. Just like a mutual fund, a company whose management is investing well enough to generate return on capital of 15% is usually a more attractive investment than a company that return only 9% on its capital. In this video, I'll explain two methods for analyzing corporate profitability. One is return on capital method, the other is free cash flow method. Let's start with return on capital. Return on capital can be estimated by calculating ratios like return on assets, return on equity, return on capital employed, etc. This is the Excel spreadsheet I use to analyze the profitability of a company. You don't need to enter any of these numbers. All these numbers, formulas, conditional formatting, etc. are generated automatically with a click of a button. How to do that? I have already made a video on that. Or you can follow these 4 simple steps to use this Excel sheet. You can download this Excel sheet for free. I gave the link in the description box below. What is DuPont analysis? It's a useful technique used to decompose the different drivers of return on equity. Decomposition of ROE allows investors to focus on the key metrics of financial performance individually to identify strengths and weaknesses. There are 3 major financial metrics that drive return on equity or ROE. 1. Operating efficiency. 2. Asset use efficiency. 3. Financial leverage. Operating efficiency is represented by net margins. Asset use efficiency is represented by asset turnover ratio. Leverage is measured by equity multiplier or financial leverage. The first component of this DuPont analysis is return on assets. It's simply net margin into asset turnover will give you this return on assets. Net margins is net profits divided by sales, and it tells us how much of each rupee of sales a company keeps as earnings after paying all the costs of doing business. Asset turnover is sales divided by total assets, which tells us roughly how efficient a firm is at generating revenue from each rupee of assets. Multiply these two and you will get return on assets, which is simply the amount of profits that a company is able to generate per rupee of assets. Think of ROA as measure of efficiency. Companies with high return on assets are better at translating assets into profits. Return on assets helps us understand that there are 2 routes to excellent operational profitability. One, you can charge high prices for your products, which is represented by high margins. Or 2, you can turn over your assets quickly. Often you will see companies with lower profit margins, such as grocery stores and discount retailers, emphasize high asset turnover as a way to achieve solid return on assets. For any business that can't charge a big premium for its goods, tight inventory management is critical because it keeps down the amount of capital tied up in the assets, which helps pump up return on assets. On the flip side, companies that charge premium prices can afford to have more capital tied up in their assets because they can make up for low asset turnover with high profit margins. Just using return on assets would be fine if all companies were big piles of assets, but many firms are at least partially financed with debt, which gives their returns a leverage component that we need to take into account. So our next measure of return on capital is ROE. Return on equity is a great overall measure of a company's profitability because it measures the efficiency with which a company uses shareholders' equity. In other words, it measures how good the company is at earning a decent return on the shareholders' money. Think of it as measuring profits per rupee of shareholders' capital. To calculate return on equity, multiply return on assets into financial leverage ratio, you will get return on equity. Financial leverage is nothing but assets divided by shareholders' equity. So 26.19% into 2.46 will give you this 64.4% return on equity. Financial leverage, which is essentially a measure of how much debt a company carries relative to shareholders' equity. Unlike net margins and asset turnover ratio, for which higher ratios are always better, Financial leverage is something you need to watch carefully. As with any kind of debt, a judicious amount can boost returns, but too much can lead to disaster. Look at what kind of a business the firm is in. If it's fairly steady, a company can probably take on large amounts of debt without too much risk, because there is only a small chance of the business falling off a cliff and the company being caught short when bondholders demand their interest payments. On the flip side, be very wary of high financial leverage ratio if a company's business is cyclical or volatile. Because interest payments are fixed, the company has to pay them whether business is good or bad. Therefore, we have three levers that can boost return on equity. That is net margins, asset turnover ratio and financial leverage. Because net margins into asset turnover ratio into financial leverage is equal to return on equity. As a rule of thumb, I look for companies with return on assets of at least 8%. Financial leverage less than 4 and return on equity of at least 15%, but if it's above 20% then I would really get excited. For example, a firm could have only so-so margins and modest levels of financial leverage, but it could do a great job with asset turnover. Companies with high asset turnover are extremely efficient at extracting more rupees of revenue for each rupee they have invested in the hard assets. For example, Hero MotoCorp comes into this category. Its net profit margins are modest, that is, last 10 years average net margins is 10.5%, but its asset turnover ratio is high. That is why it is able to achieve high return on assets, and its 10-year average financial leverage is 1.9, which is also modest. So, Hero MotoCorp with modest margins and modest financial leverage able to achieve high return on equity, that is 10-year average return on equity of 42.8% with the help of high asset turnover ratio. Some companies could also excel at convincing its customers to pay up for its products. Asset turnover might be just modest and the firm might not have much leverage, but it would have great profit margins. For example, Bajaj Auto comes into this category. Hero MotoCorp's margins are only 10.5%, but Bajaj Auto's net margins are 16.7%. As you can see, its asset turnover is low compared to Hero MotoCorp. Hero MotoCorp asset turnover is 2.2, whereas Bajaj is only 1.4. But with the help of high margins, it is able to generate high return on assets. As you can see, its 10-year average return on assets is 22.8%. Hero MotoCorp's 10 years average return on assets is 22.3%. Both Hero MotoCorp and Bajaj Auto's financial leverage is modest. Here you can see Hero MotoCorp's last 10-year average financial leverage is 1.9 and its 10-year average ROE is 42.8%. Bajaj Auto's 10-year average financial leverage is 1.6 and its 10-year average ROE is 37.4%. Even though Hero MotoCorp's and Bajaj Auto's return on assets is almost same, but still Hero MotoCorp's ROE is slightly higher than Bajaj because of its higher financial leverage. But in conclusion, both Hero MotoCorp and Bajaj Auto is earning superior returns on equity without taking much financial leverage. Finally, a company can boost its return on equity to respectable territory by taking good size amounts of leverage. For example, TVS Motors comes into this category. Its 10-year average margins are very low, that is only 2.8%. Its asset turnover is modest, but because of its low margins, its 10-year average return on assets is only 5.3%. Our minimum criteria is 8%. But TVS return on assets is less than our required criteria. That is why these cells are in red color. But even though its return on assets is very low, it is able to post high return on equity. That is, its last 10-year average return on equity is 20%. The major driver for this high return on equity is its high financial leverage. As you can see, its 10-year average financial leverage is 4. So even though TVS is earning high ROE, I will not get excited because it is low quality return on equity. That is, TVS is earning high return on equity by taking large amounts of debt. As you can see, in 2019, TVS Motors financial leverage is 5.34. Debt to equity ratio is 2.93. Interest coverage ratio is only 2.39. So this company's financial health is in poor shape. Hence, investing in such companies is very risky. DuPont analysis is very helpful because as you can see, even though Hero, Bajaj and TVS are in the same industry and earning high return on equity, but each of these companies are able to generate high returns for different reasons. Hero MotoCorp is able to generate high return on equity with the help of modest margins and modest financial leverage, but its asset turnover is high. Bajaj Auto's asset turnover is modest and financial leverage is also modest, but its net margins are very high. That is why it is able to generate above average return on equity. With TVS Motors, its net margins are very low and its asset turnover is modest, hence its return on assets is low, but still it is able to generate high return on equity because of its high financial leverage. In conclusion, Hero and Bajaj are generating high quality return on equity, but TVS is generating low quality return on equity. Now, what is return on capital employed? This ratio measures a company's profitability and the efficiency with which its capital is used. In other words, this ratio measures how well a company is generating profits from its capital. The return on capital employed ratio is considered an important profitability ratio and is used often by investors when screening for suitable investment candidates. Now, what is the formula for return on capital employed? It is nothing but operating income divided by capital employed. Operating income is nothing but earnings before interest and tax, that is EBIT, and capital employed is equal to total assets minus current liabilities. So in calculating return on capital employed, numerator is operating income and the denominator is capital employed. Now the numerator, that is operating income, shows how much a company earns from its operations alone without regard to interest or taxes, whereas its denominator, that is capital employed, is the total amount of capital that a company has utilized in order to generate profits. It is the sum of shareholders' equity and debt liabilities. It can be simplified as total assets minus current liabilities. Now you might be thinking, what is the difference between return on capital employed and return on equity? The major difference is return on equity analyzes profitability related to a company's shareholders' equity, but return on capital employed considers debt and other liabilities as well. This provides a better indication of financial performance for companies with significant debt. As a general rule, I like companies which consistently generate above 15% of return on capital employed. But companies that consistently generate above 20% is really great. Remember, with return on equity and return on capital employed, consistency is very important. I look for companies where at least 8 out of 10 years company should generate above 15% return on equity and return on capital employed. Otherwise, I will not invest in such company. If you remember, I mentioned that there are two methods to analyze corporate profitability. One is return on capital method, which we just finished. Now let's look at second method, that is free cash flow method. Cash flow from operations measures how much cash a company generates. Cash flow from operations doesn't take into account the money that a firm has to spend on maintaining and expanding its business. To do this, we need to subtract capital expenditures, which is money used to buy fixed assets. The result is free cash flow. So free cash flow is nothing but cash flow from operations minus capital expenditure. But why we need to calculate free cash flow? Because we need to be able to separate out businesses that are net users of capital, that is the ones that spend more capital than they take in, to the businesses that are net producers of capital, because it's only that excess cash that really belongs to us as shareholders. You may sometimes see free cash flow referred to as owner's earnings, because that's exactly what it is. The amount of money the owners of a company would withdraw from the treasury without harming the company's business operations. A firm that generates a great deal of free cash flow can do all sorts of things with the money. That is, save it for future investment opportunities, use it for acquisitions, buy back shares, and so forth. Free cash flow gives financial flexibility because the firm isn't relying on capital markets to fund its expansion. This is L&T's free cash flow. Firms like L&T that have negative free cash flows have to take out loans or sell additional shares to keep things going, and that can become a risky proposition if the market becomes unsettled at a critical time for the company. It's tough to generalize about how much free cash flow is enough. However, I think it's reasonable to say that any firm that's able to convert more than 5% of sales to free cash flow, that is, divide free cash flow by sales to get this percentage. If this is more than 5%, then the company is doing a solid job at generating excess cash. Now let's put return on equity and free cash flow together. One good way to think about the returns a company is generating is to use the profitability matrix, which looks at a company's ROE relative to the amount of free cash flow it's generating. Now let's look at top right or green matrix. Here we can see companies like Hindustan Unilever, Nestle, Asian Paints, etc., which have very high return on equities. People write books about how to manage a business as well as these companies do, and it's very easy to see why. They are all money machines. Investors pour new money into them and large amounts of extra money get spit out. Their managements are very good at earning a high return on shareholders' money. If you follow any of these companies, you will notice that they have another thing in common other than high ROE. Their stocks always trade at premium valuations, because a company that can earn a high return on its shareholders' money is worth more to same shareholders. And if you look at free cash flow, these companies are also very good at generating high free cash flow. So as a rule of thumb, companies which earn high ROE, that is above 15% consistently and generate free cash flow to sales of more than 5% is considered to be great company, as these companies are low risky and are good candidates for creating massive wealth in stock market. Now let's look at bottom right or blue matrix. These are companies that are generating high return on equity, but its free cash flow is low or negative. Companies like these aren't generating much cash because they are using all or most of the cash the business generated to invest in expansion. They are investing heavily because they hope that those expansion efforts will pay off in the form of fat profits in the future. You would be taking a lot less risk investing with older businessmen than you would with the young entrepreneur. But though that young fellow might just pay you back many times over. Just remember that for every Jeff Bezos, Steve Jobs or Jack Ma, there are literally hundreds of entrepreneurs who never paid their investors a dime. There's nothing wrong with investing in entrepreneurs of the world as long as you know that what you are getting into. A profitability matrix can help you separate your long shots from your core holdings. Think of this upper right corner where companies like Hindustan Unilever, Nestle, Asian Paints sits. This is the sweet spot, that is excess cash and the ability to earn a high return on capital. They have low levels of business risk, but they can be very risky stocks if you buy at high valuations. In bottom right or this blue matrix, you can see companies that are reinvesting all of their cash in expansion but are still able to generate a high return on equity. If these companies have profitable reinvestment opportunities, they should be spending all the cash they generate on expansion. If you look at this top left matrix or gray matrix, these are cash machines. These companies generate high free cash flows, but they are generating poor return on equity. And in the bottom left or red matrix, these are bad businesses. That is, they earn return on equity of less than 15% and free cash flows are also less than 5% of total sales. But most of these are young companies which haven't yet proven that they can earn a decent return on equity. They are spending tons of money, but they are not yet making it pay off very well. This is where most speculative and high risky companies hang out. These companies are generally long shots because it's still unclear whether all of that heavy investments will ever generate an attractive return. Personally, I only invest in companies which are in this green matrix and in this blue matrix. I avoid companies in this gray matrix and red matrix. Now this is the profitability matrix of Hero MotoCorp. Here you can see Hero MotoCorp's last 10 years free cash flow to sales is 7.04%, which is above our required criteria of 5%, and its ROE is 32.7%, which is above our criteria of 15%. So that is why you need to choose great company. But if its ROE is greater than 15% but free cash flow is less than 5%, you can choose good ROE but bad free cash flow. With the case of Hero MotoCorp, it's a great company. If you have any doubts, please let me know in the comment section. For more videos, subscribe to my YouTube channel Investor Diary. Thank you for watching.